Okay guys, gonna do a little tips and tricks video for you. I'd like to do more of these, but I just don't have a whole lot of time. Anyways, if you're familiar with options at all or know a little bit about it, try and follow along. I'm gonna try and explain how to make money with options basically in somewhat simple form, and really just kind of show you this website I use, optionsprofitcalculator.com. It's this one. So with this website, it's a very basic website, but it actually is very powerful in the same way. And I just kind of started messing around with it, and you can really learn a lot of things, how it works. So we're going to use GME as an example of a stock and how to make money with it, and how to use this website to figure out what to buy and what to sell and how to do it. So if we look at GME price action, we'll look on the hourly chart, and then or daily, or however you want to look at it, and you make a prediction. So you think there's any sort of numbers predictions you can make. You could say, I think GME is going to stay between 150 and 160 until Friday, or I think GME is going to stay above $150 by Friday. And I'm saying by Friday, you can do by 2022, February 19th, 2021. Like, you can pick a date on an option. So I'm just, for hypothetical, I'll say just by Friday. I think GME is going to stay below 200 by Friday. I think GME is going to go up to 240 by Friday, but not go above 260. See what I'm doing here? So this is why options are, you know, it's hard to win with options, because you have to predict it with timing, and it's difficult. So with something like GME, if I think a short squeeze is coming, that's what we'll say. I'll say, okay, by Friday, I think there'll be a short squeeze on GME, and I think it's going to be at $1,000 a share, let's say, by Friday. And that's crazy, right? I mean, it's at 178 now. Who knows? I'll say it'll be $1,000 a share on Friday. I'll come in here, and this is under the option finder. So there's all sorts of cool stuff on here though. Strategy calculator, you can just learn about how different types of plays works, all sorts of stuff. But I'm just gonna do option finder for now. And I've actually never used this until today, and I'm like, wow, that's actually really nice. I'll type in the ticker GME, get price, load up the price, and then expected stock or expected price. So we're gonna say, what do we say, 1,000? We'll just say 1,000. $1,000, and this is where we can change it to at close. At close, so basically when it expires, when the option expires, or above or below. So this we're just gonna say at close to start. And then you can do it by a specific date. To keep it simple, I'm just gonna pick, I haven't even started messing with actually by a specific day. I'm not sure how that would. We're gonna just do it for Friday. So this is the next option expiration date. It's 4:30. That is on a Friday. That's in 3 days. So we'll pick that one. Budget for trade. I haven't messed with that. You can put in, I guess, a budget, how much you want to spend. I don't really want to know that, because I just want to see the best return for my money. So, and then here, I think by default it just has long call selected. And if you're not, if that's all you're comfortable with, no harm in that. You need to learn about credit spreads and debit spreads on another video. Yeah, so we'll just start with long call. So then you do find options, and it just loaded from the option chain. It just loaded the theoretical best return you could get based on the price of the option. So they say a long call, which is just buying a call, going long, buying a call, 1 times the 30th, which is 30th of April, that expiration, 6:30 strike call. And last they saw it cost 10 cents for that contract, which is $10. Maximum risk is $10 because you're buying a long call, and if it doesn't, basically that's your max risk. Estimated return at target price is $36,999. That's insane. That would be a $369,000 or percent return. So you don't know what it's going to be at the expiration, so there's no way to know that. But they're basically saying if GME is at $1,000 on Friday, this is theoretically what that option would be worth. This doesn't take into account for implied volatility. When options move, or when strikes move quickly, when stocks move very quickly, you get a lot more IV, and so the option could be actually worth a lot more than that. Or yeah, I guess it couldn't be less. I think this is probably the least it could be worth, because this is just assuming 100 shares. Yeah, okay. So we won't go more into that, but then you can click view detailed estimates, and then this is cool too. And this is where you get this option set up, and you can do this also if you go to strategy calculators, and then you can do long call, bullish, long put, bearish, and then you just plug in numbers. But yeah, it basically just brought it to this. So then it has GME, has a stock price, has buy right. So buying is buying, writing is selling, but we're buying, and this is the, and if you hit select option, this shows you the option chain, different expiration dates, calls, puts, mid price, ask and bid and ask. So it plugged that in for us already. The market is closed right now, so some of these numbers could be wrong as far as, because options don't trade after hours. Price per contract says 1 cent or 10 cents, which is $10. Contracts 1, total cost $10. You don't need a manual, and this is if you know the contract is more, or you want to, yeah. Basically, if you want to manually plug in stuff there. Stock price range, this is just for this thing down here. You hit calculate if this hasn't come up. And then this will show you what it's worth at a certain strike price on the certain day. And this isn't a definite thing because there's IV and they can't predict that. But yeah, so this basically shows you on a long call, if on the 29th, which is Thursday, if the strike, or if the stock's at $310, this will be worth $21, or 210% of your initial investment. It could be worth more than that. I don't think it'd be worth less, but this is just kind of a rough guide to show you what's going on with your long call. So that's a long call, and GME, the IV right now is quite high. I think it's for these, it's probably like, see, the 630s maybe 400, 300. That's really, really high. Let's go back. I just hit back. Let me hit back again. I'll spread calculator. There we go. Okay, option finder. If you're a little more advanced, and this is what I like to do, because theoretically for me, I'm like, okay, it could hit 1,000, but let's just say, yeah, okay, I think it's gonna hit 1,000 on Friday. But that might not be the best play. That's 369,000% return, which that's really good, but maybe there's one that gets better return. So I'm just gonna select all these and hit find options. So here's a better one. 399,000% return. And why is this? So look, this one was a 630 call. You can see right here, this was the one that they just showed us, but I just changed it so it'll show us the other options. This one's a call debit spread. If you're buying naked calls and the IV is high, it's sketchy, because basically your break-even price is much higher. And I can try and show you guys with E-Trade. So April 30th, we're talking about the 630 call, right? Oh, there's even a 690 call. Oh, see, look, it's not even saying to buy the if I think it's going to close at $1,000, it doesn't even say to buy the 690. It says to buy the 630. And that could just be because the spread, but that's actually interesting that they say that. Yeah, look, because it's the same price. So look, the last trade on here was 10 cents. The last one was on here was 8. But the bid and the ask are pretty much the same. So the mid price is probably about the same. That's why they say that. Another little option trick for you. Look at that implied volatility, 500%. So they say 630. If we look at this one trade, we can analyze. This just says infinite because, of course, it can go up to infinite. Max loss $10. Break even 6. I don't think this is right because the market's closed right now. Well, no, it actually might be because it's the cost to entry of that is so little. But if this was expensive, even if the stock got to your strike price of 630, since you paid that premium, it might have to go to 635 or 640 or 650 before you even break even. So that's why when you have high IV, you're paying a big premium, and that's why in this case a debit spread would be better. So this actually caps your gain, and that's where you have to decide what you want to do. If you want to say, I think it's going to go to 1,000 for sure, or you say, I think it's going to go to 1,000, but I think it also could go to 5,000 by Friday. So then you can put that in. But if you think 1,000 is definitely the top, you know, so I'll just do a debit spread, and this one only costs $1, and I can show you how to do a debit spread really quick. There's different brokerages that do it. You're basically buying and selling a call. So what are they saying? They're saying 630 and 670. So you would go to 630, you'd buy a call for 630, you add an option onto that leg, it'd be selling a call for what, 670? Yeah, and then says I could get filled for $1. So then I'll show you the snapshot. This will blow your mind. Okay, so for $1 investment, we could get back $3,999 if the stock price is above 678 by close by Friday. So it's very easy then to see how you can scale this and how you can make money on, say, a short squeeze when the IV is already super high and GME's ran all the way up to 500, 1,000, 2,000, and then it's dropped all the way back down to 100, 200, and you're like, that's not it, that's fake. IV is going to be crazy though, and that's when you're going to want to say, okay, let's do a debit spread. And instead of just doing one of them that costs $1, you bump those numbers up, rookie. You say, let's do, like, you know, at this point you've already made, you know, $50,000 from the previous options that you worked out, and you've sold those because you're a genius, and now you're like, I want to get some debit spreads. And, you know, I only spend like 1/100th of the gains I've already made and just spend $411. And then, yeah, then I'll make 1.6 million on that $411 investment. Boom. That's how it's done. And this won't fluctuate. This won't fluctuate, so debit spreads won't work. I wasn't going to do a debit spread video. Debit spreads don't work like naked calls in the sense that if it shoots up really quick, your debit spread is not going to shoot up really quick. It's going to go with kind of the stock price because you also have a call that you sold. So that's negating the theta and the IV. So all the quick IV that you get on the naked call that you bought, you're also losing on the call that you sold. That makes sense. So really what you want is you want that stock to go up, you know, go up to above your higher strike price by expiration. Another thing is you want, I mean, typically, well, let's actually just look at this. So we'll do view detailed estimates. This gives you a good picture of where the stock price has to be for a certain deal. So look, say we're at 190 today. See how much better this looks than that other one? The other one, like, you really had to shoot up. This one, look, 382, you're at 7,200% already. But look, say if it went all the way up. So this is a 6, let's show more, let's show like 1,000. So I'm just changing the little graph down here, so it'll show higher. So let's say we got that debit spread down here, and it's, what is our debit spread? The 630, 670. So you're like, okay, great. This thing goes over 670 tomorrow. This thing goes crazy. Goes to $1,000 tomorrow. I'm going to cash out and I'll get max profit, because there is a max profit on this. It caps your gains. And that's why if you think it's going to go even higher than that, that's when you can say, okay, I'm not going to do a debit spread. I'm going to do a naked call. But look, on a debit spread, it's a little different. When it goes up to 980, without the time decay, because you actually want time decay in a sense on a debit spread, it's not, you're not at max profit. This is max profit over here, this 399. So all of these are max profit. See? But look at this. This is crazy. It's almost at the strike price at $980. How are you not at max profit? Right? But then you'd be at max profit way down here at 672 just the next day. That's how debit spread works. So to put that kind of in a picture, a naked call up here, if the strike price at 980, it would be worth more, most likely. However, if it comes down here that next day, this will probably be worth more. Capture gains on a debit spread. Let's go back real quick. Let's look. So they show us different ones. You can just do a naked call right here, and you can just play around with the numbers. Say you think it's going to be at 5,000. So I predict if I say 5,000, I think it's going to be at, I don't think it's going to give me a debit spread. Now let's check. Maybe it still will, but I don't think it will. If it does, it's broken. No. All right, there you go. So no debit spread. Now it's just a naked call. And this is where it's, if you're buying a naked call with IV so high, you're putting, it's got to go, you're predicting it to go so high. So high. Right now is right now, just with GME with high IV. If it's got low IV, 30, 40%, yeah, dude, naked calls all day, limited upside if you expect a huge move. 5,000 though, yeah, you can do this. It's $9 to buy this call, and then you can make potentially 432,000 on it. It's, what's that, $4 million or 4 million% return. This is like some of the stuff that DFV was getting, just because it had that much price action. IV was low, it'd been flat for a long time. Let's look at what 2,000. That might be a debit spread, that might be naked, I'm not sure. Long call, still naked, so still a naked call. But at 1,000, wasn't it 1,000? It said you should do a debit spread. Because they have options that high, so they have an option up to 690, 640, 690. And yes, this caps it though. So if you think it's gonna go to like 1,500, or even if you're close to this, you might want to do a naked call. And then it goes to, yeah, then just goes to a naked long call. But to buy, so if you think it's gonna go to 1,500, and then, but you don't want to then go and buy like a at the money call, because you're gonna pay such a premium for that. So yeah, that's kind of the options profit calculator. Good website, man. There's a lot to it, and then like it's crazy all the stuff you can do on here. GME, to me, okay, well there's more. Let's just do another little bit. So we did at close, 1,500 at close. I'm gonna do something a lot more simple, and this is actually a play I'm doing right now. I think GME is gonna stay above 175 by Friday. With daily, I won't go over the reasons why, but yeah, I think it'll be stay above 175. We can put that in here at close, no, or above. We'll do 175 or above. It just has to stay above 175. Well, this is getting into selling premium, but okay, anyways, by Friday, selling premium. Here we go. So now it changed. It took out long put, short naked call, because now we are, if you're selling premium, if you change this to at or above or below, you're going to be doing credit spreads, or I guess debit spreads too. That's interesting to think about. But yeah, okay, let's do find options. And I love credit spreads because you don't, with naked calls, naked puts, you want velocity in your price action. Credit spreads, you're just letting the time decay, and that's what you want. So this is pretty much the play I set up right here. Is a put credit spread. It's bullish, but it doesn't have to be. The stock just has to stay above 175. So kind of cool, really, just to use this and say, and you can do crazy numbers, but you're just not going to get as much for your collateral. So on a play like this, this just takes collateral to put up. The collateral, let's see, collateral would be $143. The credit you'd get, which is basically your max gain on it's $107. So if you made it crazy numbers, like I think it's going to stay above $50 by Friday, which yeah, all of us do. You're not going to get a whole lot of credit. But there's a call debit spread right there. Oh, call debit spread. See, I'm learning on this thing too. That's interesting that's what they would recommend. But look at your return on your investments, 0.8%. So this is where you get theta gang, and you get the phrase picking up pennies in front of a steamroller. And yeah, it's great. You keep picking those pennies up till you get squished. So this one, maximum return is not even showing anything. That's crazy. But basically, say, just for example, say you'd get maybe $1 credit, and then you're risking $500. Your probability of it happening are like 99.9%, but you're not receiving much credit for it, and you're tying up that collateral during that time. Let's go back to the other one. I just want to show you guys the chart on it. I haven't even looked at the chart, but so we still have that expiration for that contract, and you could change it to a later contract, and you could also put in a certain cost that you're willing to risk or pay if you're buying premium or selling premium. Buying premium would be debit spreads, naked calls, naked puts. Selling premium would be credit spreads, selling calls. So here we go, put credit spread bullish. Let's view detailed estimates. There you go. So this gives you a visual representation of what's going on here. The price right now, I don't even know, it's around 180. So as you see, it doesn't matter anywhere up. This is all max gain up here, as long as it's above 175. So with these, even if you expect a movement up, you can still do these and they're much safer. Because it doesn't have to go up quick. It can just slowly grind up, and this thing will slowly lose value. So I could even close this early for close to max gain. And typically I do that with credit spreads. Once I'm at like 80%, I'll usually close it just in case. So say GME goes up to say it goes up to 193 tomorrow, I'll be at 44%. Like, I want to hold on. And then it just consolidates there for 2 days, and then probably right here I'd sell it 74%. Or you could wait one more day, and if it stays up that high, then sell it for the 100 or 74%. Oh, that's the most you're gonna get on it, is 74%. It's 74.1, that's 74.8. But it doesn't matter if it's down here or up here, you're gonna get max credit. Check out profit options, profit calculator. Big plug for them, I guess. They're yeah, I'm gonna be looking at this once GME starts squeezing, it goes crazy. Be trying to figure out, because naked calls really aren't the play, and that's why I actually closed some of mine. I had some today that I closed. I was like, well, I really should. I looked into this. I'm like, yeah, I should be doing more debit spreads already. I thought IV was low enough to where naked calls still are worth it. It's really not, unless if you're thinking, okay, it's gonna be like this shows, 5,000. If it's 5,000, yeah, you need a naked call to be able to cap or get the most gains on that. Or if it's above a certain amount, I think it's, what was the price, like 1,500 and above. So this is constantly changing. When markets open, it's going to change. Like, it's going to keep changing with IV and Delta and all the Greeks. So yeah, still a long call. But if you think 1,000, you could cap your gains and still make great money. And then it's also nice because then on your exit strategy is real easy. At least it can be. You can say, I just want max gain. And you can, even after you open up this debit spread, you can then put in an order to close it. Not the same day, it's pattern day trading if you're under 25K, but the next day you could put in an order to close it at max gain if you want, and just don't even worry about it. However, you probably want to close these early. You might not want to make it all the way, maybe 80% or so. But yeah, look, so if you think 1,000, that'd be great. I mean, you've got huge returns on here. You've got 5,000, no, 50,000%. So, and we saw that on the thing. This is a 640, 690. That's what we saw. So you don't have to do, I mean, yeah, naked call, yeah, maybe the difference between, could be a huge difference if GME goes to 10 million a share. Then yeah, I'd rather have a naked call for sure. But you could make 10 million doing some debit spreads with less risk. Anyways, that's all I got today, guys. Sub up, like up, comment down. Happy Money sticks around. Woo! Follow us on Twitter at HappyMoneyYT. If you made it this far, type in, oh, what were we doing? Here it is. OPC, Options Profit Calculator. Peace out.